All right, let's talk about the next sticky note, Patrick, which is consumer loans. Loan growth has fallen off a cliff, which means that the banks and the loans institutions, essentially, people are not borrowing money like they used to. Classic, because rates are so much higher. And as a result, as you've all frequently mentioned, this is having an impact on the economy. There's no doubt about it. So they got a couple great charts about this. And it really starts with residential mortgages here, Patrick. You can see the precipitous decline in terms of growth. And this is primarily simply because the interest rates are so much higher. Therefore, people are just not borrowing like they used to.
Well, it is interesting because we go back. What will the banks do? What will the Bank of Canada do? When you start to consider that what you just said a little while ago was banks are in the business of making money and they're in the business of putting capital to work. And that means mortgages. Well, when people quit borrowing money, they're not making the money that they're meant to make, which is in the interest payments. Having said that, this increase in amortization kind of maybe offsets that. So it is a very complex. If you try and connect the dots, you'll lose your mind. But ultimately, again, we go back to the slowdown economically. That's being driven by, number one, cost of living. Number two, the fact that consumers aren't consuming as much, and that data keeps showing up, and that in fact will slow the economy.
If and it's not just, by the way, it's not just residential mortgages. I've got another great chart here that shows kind of mortgages, the consumer loans, the total. It's all really coming down quite quickly here, Patrick, from its high, which is essentially just at the end of 2022 is where the kind of height of it all was. And this is the percentages on the left. It's always important to kind of, I think, for people to understand the charts. The percentage on the left is the growth. So if you look at where it stands today at the end of 2023, we're kind of sitting, if you look at the total, that gray line there, you're kind of sitting at essentially 3%. That means it's 3% growth from last year. So it's still growing, Patrick. It's just not growing at 11% like it was at the end of 2022. And so from 3% to 11%, or I should say from 11% down to 3%, is a significant drop, but it's still growing. It's not negative. It didn't go into the negative territory like it did, by the way, at the early part of 2020. And that's the only time you've ever seen it go negative on this chart since 2015. And that's only because of the pandemic, obviously.
Yeah, but I think there's a couple things you got to pay attention to. When you saw it come down, it was because people were locked down. They couldn't get out to spend money. But I think what we can all learn from this particular chart is that, the money that flooded the economy, the government printing and all the checks that went out, all of the things that happened through the pandemic, you see what that meant. When you flood the market with capital, we see what happens economically. And that chart is a really good indicator that the thing that we can go back to that chart, JG, when you look at that, right now, I agree, we're not kind of upside down. The word there is yet. On one side of it, when we look at what happened when they flood the market with money, the trend is your friend, right? It's going up and that all makes sense. All that capital flooding into the market, everybody's having a party and getting rich, and it's all very, very good. To your point is that here's the issue is that in this case, the trend is not your friend. And as much as we're not upside down, we're not back into where we were in, let's say, 2020, 2021, the reality of it is it's trending the wrong way. So we're just not on the other side of that yet. And I think that's where we're going to face some challenges going forward. And I think we're just getting warmed up.
Another chart, Patrick, this one here that show the chart of banks and the HELOCs in terms of where they've been going. I like this chart, goes back to 2015. You can see it's been definitely trending in the right direction, or I don't know if this is the right direction or wrong direction. The point is it's a direction. It's been going in that same direction since 2015, except for that kind of blip mid 2021 up to mid 2022. You can see how it's kind of started reversing. What I do find interesting, though, Patrick, is recently the chartered banks were going to come up with a rule that said they would not allow any more HELOCs to be used for down payments on investment real estate. That was, a lot of investors don't know, but that rule was literally minutes from being passed. And we recently found out they decided to hold on that. I think this chart has a lot to do why they decided to hold on that, because clearly the HELOCs are going in the right direction, which means people are not over leveraging their HELOCs. Based on this graph, based on what we're seeing here, there's a lot more to be said, I'm sure, about it. But I'm glad as an investor that rule didn't go through, because that would have hampered the market that much more.
Yeah. Again, it's, we keep kind of saying it. And when we're looking into the future as investors, we want to understand also what drives an economy so we can make these decisions. And when we start to see this thing slowing down, and I think, JG, we can maybe bring it up again, but at the end of the day, we're looking at this through the eyes of an investor. And when we're looking at what's happening economically, it can really shut people down. Again, it's in these kinds of markets that opportunities present themselves in terms of buying and being a rental housing provider. We can talk about rental demand and all of those things, but this chaos, this uncertainty, this kind of economic downturn, it'll shut a lot of people down. It is shutting a lot of people down. And the reality of it, as an investor, it's opening up huge doors of opportunity.
Huge doors of opportunity, exactly.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.